Thank you, Dushyant, for a very elaborate introduction. As you rightly pointed out, BCS is like my second family, and I don't really need a introduction, at least at a forum of the society. And it's always a passion to interact with fellow professionals at the society. Thank you, President Anand, for inviting me to share some of my thoughts on this topic, which I would believe is a sort of a catch-all type of a topic covering various different situations and clarifications, notifications, and amendments which have come in over a period of time. The president, in his introductory remarks, referred to the busy days at BCS over the last 10-12 days. And today, most of the participants are from the indirect tax space. And all of you would agree that as far as the indirect tax space is concerned, ever since the GST Council meeting, which happened on 22nd of June, the 53rd instance of their meeting, we have seen every few days something or the other coming up. And therefore, it's not really just 8-10 days, but the entire month, which has kept all of us as indirect tax professionals a busy way. I would say, important and welcome relief is that most of the busy days are interpreting provisions which are mostly beneficial to the taxpayers. And in that sense, we could really see a lot of change in the mindset of the authorities and also the way in which various types of clarifications which have been issued over the last 1 month. So we have a long agenda to cover, and therefore, without much ado, let me straight away take you through one by one each of the provisions which we are going to talk about. And to set the context, I think the entire discussion which we are going to talk about today, the topic talks about recent amendments, and I would believe 1 month is a fairly recent timeline. So we would anchor on the GST Council 53rd meeting, which was naturally followed up on the same day by a press release on 22nd of June. And thereafter, there have been a series of clarifications, notifications, rules which have been amended. And finally, we have the Finance Number 2 Bill 2024, the popularly known Union Budget, which has been presented on 23rd of July. And as you can see, we've tried to bring about various references of the circular's notification number and the dates. And you will see that every few days, there has been something or the other which has kept on coming in. As a law student, when I studied law, I always understood that the act is supreme, rules come thereafter, notifications come at a slightly lower pedigree, and finally comes the circulars. But indirect taxes are always indirect and they work in exactly the reverse fashion. And that's what you will see over here. You saw the press release, which is more like a policy statement of the GST Council coming in first. Thereafter, some part of that getting implemented through a series of circulars which came earlier at different tranches. And thereafter, there were rules, amendment to the rules and notifications. And finally, we had the Enabling Act, which was proposed by the Finance Number 2 Bill 2024. But be as it may, we are all right from the era of excise and service tax. We have been used to this process of placing the cart before the horse. So I don't think we should spend too much time analyzing that factor. But yes, that is very much there. Again, as a primary law student, we always understand that whenever we are looking at any notification, unless specifically mentioned, the notifications will be effective from the date of their publication in the official gazette. We find that in many of these notifications, there's a specific date which have been mentioned, or in certain cases, especially in the amendment to the rules and the act, we are told that there will be a separate notification which will make the provisions effective. Therefore, some of these provisions would become effective, maybe with retrospective effect, current effect, or some would be even from a future date. So each provision, we will have to deal with the different date of its effectiveness. As far as circulars and clarifications are concerned, again, we all of us understand that clarifications or circulars are expected to clarify the position of a law and not to stipulate a position of a law. And therefore, by general logic, most of these circulars and clarifications would have a retroactive or a retrospective impact. So that is one important facet which we will need to keep in mind. And when we look at this entire series of amendments and clarifications, an interesting factor which I could see in the current trend was the content and the volume of the content. And when we just looked at the first set of circulars, that itself was around 112 pages. And when we total up all these amendments which have been notified and brought about, you will find that there is more than around 200 to 250 pages of content which has been created over the last 1 month. Friends, make no mistake, this 200 to 250 pages of content has to be contrasted used with the cumulative content of CGST and the SGST Act, which is the core. And you will find that over the last 7 years, including all the amendments made to those acts, we have a content of 80 pages. And this is where we need to really look at the entire concept and step back for a moment and think whether we are overstating things. Is there a deluge of statements, maybe to a large extent beneficial? So as taxpayers, they are not going to protest. As consultants, we will not protest. But are we somewhere not prioritizing the right things? Is it that there are some problems in the basic legislation which require the governments to come time and again, the council to come time and again with repetitive types of clarifications on the same point? Let it be something like saying that investment in a subsidiary is not a service, which was a clarification last year. Things didn't stop there. We have this year something saying that giving of a loan by a parent to a subsidiary is not a service. Is there something wrong in the fundamentals that every now and then for every specific type of an activity or a transaction, the GST Council and thereby the CBEC has to come out with elaborate clarifications, elaborate explanations, trying to bring it out? And I think that is something which, when we look at the post-budget representation, we will have to think through that and perhaps suggest some fundamental changes in the basic structure of the legislation. We are aware 7 years ago when GST was introduced, it was a sort of a very limited time available for legislation, and therefore a major part of the act was just an amalgamation of the existing legislations. But perhaps 7 years down the line, it's time to really revisit that entire legislation and see that are there some nagging issues in the act and the structure of the entire legislation, which is really creating all these difficulties, uncertainties, and thereafter a lot of sleepless nights to people. And once that happens and things are escalated, the council will have to intervene with some sort of a clarification and putting things at rest. Well, as far as the content is concerned, I would use the word content similar as a common word for all the different modes of clarifications, notifications, and amendments. We would find that the current set of content actually covers a very diverse set of situations. And most of the concepts under the GST law are somewhere impacted slightly or majorly in various areas. We have things wherein we are talking about the levy, the basic provision of levy section 9, which is proposed to be amended. The concept of supply, there are certain clarifications which go to the root of supply, and we'll look at some of them. There have been tax rate changes and exemptions, which we will quickly run through, not spending too much time on that. There are changes impacting the value of taxable supply, input tax credits, lots of beneficial amendments being brought about in the context of input tax credit. There are some clarifications relating to the place of supply and time of supply. A sort of a mini amnesty scheme is being proposed. And thereafter, we'll talk about some other procedural changes, including registration returns, appeals, and refunds and other provisions. So I think that's a lot of area to cover for today's session. And yes, we do have 90 minutes. Maybe I might go a little bit faster on some of those areas where things are a little bit settled now, or maybe which is not of day-to-day applicability to general audience or participant profile. And that's where we go to the first amendment, which we are going to speak about today. And that's an amendment to Section 9. As we are aware, Section 9, which is the provision relating to the levy, imposes a GST on all intrastate supplies of goods or services or both. And therefore, it's much wider and very, very universal, especially considering the fact that service is defined to be anything other than goods. However, there's an important exception to this levy, and that exception is that except on supply of alcoholic liquor for human consumption. And that is with a purpose that we wanted to keep alcoholic liquor for human consumption under the state legislation. And naturally, each of the states are imposing a state level VAT on these types of transactions. Now, the controversy which was brewing was around this phrase, alcoholic liquor for human consumption. And the context in which the controversy was brewing was in the case of extra neutral alcohol, which we are all aware is the strongest form of alcohol, which contains more than 96% of alcohol within it by ABV. Now, naturally, this is a alcohol which is not fit for human consumption, but that is the starting point for whichever liquor which you are buying, will it be an IMFL or a foreign liquor or an Indian liquor. This basically is a starting point, and essentially what happens is that extra concentrated alcohol, which we say extra neutral alcohol, pure alcohol, undergoes a process of dilution by adding distilled water, and maybe depending on the type of the liquor which you want to consume, there's a bit of a flavoring and packing which gets involved, and ultimately that packed liquor comes in the bottles which people consume. The issue which comes up is the liquor by itself is not a part of GST, is a part of VAT. But what about ENA? Whether it should be subjected to the traditional VAT levy or the GST levy. And that's where there were contrary provisions, and matters were being litigated in the courts. Courts were holding a view that this would fall under the purview of GST. And that would have resulted in a lot of difficulty, both in terms of the states not willing to concede their power to levy a VAT. And also, if you have a raw material which is under GST and a final product which is not under GST and under VAT, would result in a cascading impact of taxation, which is not the favored regime. And therefore, the GST Council had recommended that there should be an amendment to the provision, and let us forego the powers to tax this. Let us exclude this from the purview of GST and let it be a part of the state VAT legislation. And therefore, we now have an amendment wherein section 9 is proposed to be amended to also exclude rectified spirit and extra neutral alcohol from the scope of GST when it is further supplied for manufacturing alcoholic liquors for human consumption. So all in all, a provision which will bring in a much required certainty and clarity as far as this industry is concerned. And these are the types of controversies which would keep on coming. A similar controversy, though it's not mentioned as a part of the agenda or the notes or the explanatory memorandum, but we are all aware is an issue which comes up in the context of online gaming. And while in October we had a provision to introduce a tax thereon, for the past period the matters are being contested in the courts. And the government finds that there is no specific provision under the act wherein they could somewhere try to clarify that they want to waive off a tax. And while such type of a provision did exist under the customs and the excise regime, under the GST regime, there was no specific provision to that extent. And therefore, we have now a proposed insertion of section 11A, where there is a power granted to the central government that if it is satisfied that in general, the industry has not been imposing a tax on a particular transaction because of a genuine belief that it is not taxable or liable for a nil rate of tax. Or maybe they are under an impression that it is liable for a 5% levy, but ultimately it is held to be 18% or something like that. So wherever there is a general trade practice that there is a short levy of tax or a non-levy of tax, in that case, the GST Council can recommend that we do not want to disrupt the entire industry. Let us be a little bit magnanimous and let us waive off that requirement of a payment of tax for the past periods. And that's where this section 11A is the enabling provision, which says that the government can issue a notification in this regard and then direct that the said non-payment of tax which arise because of the general trade practice of short levy or non-levy shall not be required to be paid. Now, of course, as we are aware, whenever such types of notifications are issued, and in the past we have seen situations under excise and service tax and customs where such notifications have been issued. In most of those cases, the notifications provide that if the higher tax was collected and paid, then no refunds will be given of the so excess collected tax. And this principle of as is where is basis, which is more like a commercial concept, but is now being used very rampantly and frequently under the GST law. We find many situations where there has been some litigation, some controversy, and the government would then chip in, clarify, or make an amendment or a notification, and then say that for the past periods, we will deal with this on an as is where is basis. And we all understand that when we talk about this concept of as is where is basis, what we basically mean is if somebody has paid, it basically would not be refunded back to you. So, and here also, we have other provisions also wherein we are going to talk about a similar context, and we'll discuss the reasons for that and what are the safeguards on that point. But as a general policy, what we do when we keep on regularly prescribing as is where is basis is that we somewhere encourage litigation rather than a conservative approach towards dispute resolution. Because what we find is two taxpayers, one of the taxpayer chooses to litigate, not pay and litigate, choose the option of filing an appeal and continuously contesting in various forums at the appellate levels. He is absolved of his tax interest and penalties, whereas somebody else who chooses a non-aggressory view and chooses to pay up, he ultimately feels that he is cheated. But well, that's true with most of the amnesties or most of those types of things. But yes, we are seeing that thing happen more and more frequently as far as GST is concerned. I, in the initial part, talked about the need for having such type of detailed clarifications and was suggesting that there is something which is fundamentally missing in the act which results into all of this. And I think the key part which is missing is the vague definition of or connotation of the word supply. We are all aware section 7(1)(a) defines the scope of supply and says that supply includes all forms of supply of goods or services or both made for a consideration. Now, when we refer to this scope, it essentially leads us nowhere because we are saying supply includes all forms of supply. So you are back to square one. You are back to the same position. In Excel, we say there's something called as a circular reference. And this clause is a classic reference, classic example of such type of a circular reference. It really does not mean anything. It's a sort of a very open-ended type of a provision leading to any type of an interpretation which one would want to. This is compounded by the fact that the definition of service is defined to mean anything other than goods. And therefore, a general mindset at the level of the tax authorities is to say, look at the P&L account, look at any income, look at any receipt which comes in my P&L account or in my bank account. And once there is some receipt, treat it as a consideration. And once there's a consideration, we can always find some name for that consideration, a name for the supply relating to that consideration, and therefore presume a supply. And that type of a presumed supply has time and again resulted in lots of conflicts and a need for intervention by the GST Council. We have seen that happen last year, wherein a very detailed circular had to be issued to say that if an employee leaves an organization and notice period money is recovered from the employee, department used to take a view that this is nothing but agreeing to tolerate an act of an employee leaving early, which looked illogical because when an employee leaves an organization, the company doesn't give any service to the employee. The employer doesn't give any service. And there were matters which are in the courts. Tribunals were giving favorable verdicts. There was a high court decision interpreting the context of compensations and liquidated damages. And thereafter, last year, we had a circular, an elaborate circular, again, a beneficial circular, though there were some open-ended issues in that circular, clarifying that all of this does not constitute a supply. Similarly, when we look at the current context, we find various situations where, because of this ambiguity of what is meant by a supply, we need to address that ground level problems which arise by either legislating something differently or clarifying something. And we now go through a series of amendments and clarifications which deal with this concept of supply and the difficulties which come because of the very comprehensive interpretation of the word supply. And I think the first thing which we will talk about is the amendment to Schedule 3 brought in by the Finance Number 2 bill, wherein we are inserting two specific entries in Schedule 3. All of us here are aware that Schedule 3 basically excludes certain transactions from the scope of supply of goods or supply of services. So such transactions are treated as neither supply of goods nor supply of services. And the issue which was coming up was in a situation where two insurance companies jointly pitch for a large insurance risk to be covered for a particular single insured company. Now, typically in these types of co-insurance activities, there would be a lead insurer and there would be a subsidiary insurer or a co-insurer as we generally talk about it. While both of them jointly execute the insurance contract and provide us insurance service jointly to the insured, the entire premium is typically collected by the lead insurer, and there the share of the co-insurer is passed on by the lead insurer to the co-insurer. And this is known as an apportionment of the co-insurance premium, which is being paid. The issue which was coming up was the applicability of GST on the co-insurer. And one would believe that there would be an element of service given by the co-insurer, and there should be a GST on it. But who is the recipient of the service is a question which needs to be addressed. And there have been debates on this point, especially considering the fact that in many cases, full input tax credit may not be available, and therefore matters were under litigation. Now we have an amendment in Schedule 3, wherein we are told that if the lead insurer has paid the tax on the entire premium, then the amount apportioned by the lead insurer to the co-insurer will be treated neither as a supply of goods nor a supply of service. The council has been conscious of the fact that this should come up as an amendment in the schedule rather than as a clarification. If we recollect, in the service tax regime, we had a clarification on joint sharing of revenues in the context of film distribution. If you really look at this example, it is something similar to that. Then there are many more examples. Just like in the insurance sector, there could be two insurance companies jointly pitching for a risk cover. You would have two construction companies jointly pitching in for a project. You could have two banks jointly pitching in for a large-scale borrowing or a lending arrangement. And therefore, these types of joint provision of service by two suppliers to a single recipient is a very widespread and a commonplace phenomenon. I think the key point which somewhere will have to be addressed is whether two suppliers, when they jointly render a service to a recipient, whether there is a service given by a supplier 1 to supplier 2. Of course, in the context of insured, we now have an easy answer. We have Schedule 3, which will touch upon it, and subject to the condition of the lead insurer paying the tax, the government says, I am getting my revenue on the gross value, and therefore I am not too worried about it. The co-insurer not paying a tax is perfectly fine. Similar situation comes up in the case of a reinsurance business where there is a clear contract. There are two contracts, a contract between an insured and an insurance company, which is a primary insurance. And thereafter, there's a separate privity of contract between the insurance company and the reinsurer to provide a reinsurance service. So essentially, the reinsurer provides a reinsurance service to the insurance company. But as a general market practice, certain component of the commission is ceded back to the insurer. In a way, this becomes a sort of a discount. And that's where we are now being clarified that this ceding of commission by the reinsurer to the insurer, again, will be treated neither as a supply of goods nor supply of services, subject again to the same condition that the tax is paid by the reinsurer on the gross amount charged to the insurer. Again, for the past transactions, we are told it will be regularized on an as is where is basis, meaning in the past, if the taxes have been paid and credits claimed, then we will not dispute that, we will not interfere into that. But if it is not paid, we will not demand it. And naturally, there is no refund for any taxes which have already been paid because of this amendment coming in. So this is the amendment in Schedule 3. A similar type of a situation arose in the case of UPI transactions. As we are aware that whenever there's a UPI transaction, the UPI transaction, there is no charges levied to the payer or the receiver in any manner. And therefore, the bankers who facilitate these UPI transactions need to be incentivized in some manner. And that's where the Ministry of Information Technology provides an incentive to the acquiring bank. Now, whether this incentive becomes a consideration for the services of facilitating the UPI transaction between the payer and the receiver could have been a question. Last year, this question was clarified, and somewhere the clarification circular 190 gave a clarification to say that this incentive given by the Ministry of Information Technology is nothing but in the nature of a subsidy given by the government. And as we are aware, the definition of consideration specifically excludes a consideration given by a subsidy given by the government. And therefore, the clarification said that this subsidy is not liable for GST. So far, so good. But as we are all aware that in any transaction, there are two parties, a payer and a receiver. And therefore, at the banking level also, there are more than one banks involved, the acquiring bank, and there would also be an issuer bank, or at times there could be a chain of payment system participants. And that's where the question comes up is what is the amount, what is the incentive for an issuer bank to do all these activities? So the acquiring bank who receives the incentive from MEIT passes on a share of this incentive to the issuer bank. Again, the guidelines for this have been given by the regulatory body called the NPCI, National Payments Corporation of India. And here, therefore, the circular clarifies. And mind you, this is through a circular that we are bringing in the sort of the clarification. And the clarification says that the incentive which was given by MEIT to the acquiring bank was in the nature of subsidy. And if that 100 rupees is a subsidy given by the ministry to the acquiring bank, and that is not a consideration, from that 100, if let us say 40 rupees, 40% is passed on to an issuer bank, then that 40 rupees which is passed on continues to bear the character of a subsidy. And therefore, that also will not be liable for GST. Well, good. Again, a beneficial circular, but we are somewhere complicating. We are bringing in new concepts. We always understood that the transaction at each level has to be looked at separately and the nature has to be looked at separately. But well, here we are saying the nature of the subsidy by the government continues not only from the MEIT to the acquiring bank level, but from the acquiring bank to the issuer bank level also. And therefore, we'll give this relief. I'm sure nobody's going to object to this because this is beneficial. But as I'm highlighting that this is not somewhere coming out in the broad principles of the GST law. Being a beneficial provision, nobody is going to object to it. Of course, here they are saying that the share of incentive will be treated as a subsidy only if it is as per the formula stipulated by NPCI. If it is given in some variation, then it does not continue to be in the nature of subsidy. Again, this is something which, as principle, someone might dispute that whether just because a mandate or a stipulation given by NPCI, if I'm following that stipulation, it is a subsidy. If I don't follow that stipulation, it is not a subsidy. I don't think that's the correct way to look at that entire situation. So this is a clarification which has come in. And as I said, clarifications would typically have impact from day one. Another clarification is in the context of motor insurance claims. And the issue which was coming was relating to the taxability of the scrap which is generated in an insurance claim. So especially when there is a accident which happens, and as we understand that in an insurance contract, the salvage goes to the insurer. Now there are two ways in which this salvage is adjusted in the insurance claim. One mechanism would be the insurance company will tell to the insured that, look, I am entitled to the scrap, but I don't want to take over the scrap. You sell the scrap and I will reduce the value of the scrap from the final insurance claim. So the scrap does not move from the insured to the insurer. It is only a monetary adjustment in the insurance claim paid by the insurer to the insured. A second situation would be the insurer would take over the scrap and independently auction and sell that scrap. Second situation, I think, is a simplistic situation. Whenever the scrap is sold by the insurance company, it is in the course or furtherance of its insurance business, and it is an independent supply. Scrap is also goods, and therefore the applicable GST would be payable by the insurance company on that value. The litigation was on the first type of a scenario where the insurance company mandates the insured to itself sell the scrap and it adjusts the monetary value of salvage from the insurance claim. Now, because there is an adjustment in the insurance claim, this negative adjustment from the expenditure, the department was taking a view that this is also indirectly a supply done by the insurer to the insured, because of the principle of insurance, the owner of the scrap becomes insurer. So notionally, it is sold back to the insured, and therefore there should be a tax. And this is where the circular clarifies that no, there is no transfer of property in the scrap from the insurer to the insured, and therefore this is just a monetary adjustment, just a deduction in my expenditure. It is not a supply by the insurance company to the insured or to the third person, and therefore there is no GST liability on this transaction. That takes us to one more clarification, which I would say is a clarification number 2, because there was already a clarification which was issued in 2023. And that clarification covered certain situations, and perhaps the department was reading those interpretations in a very myopic manner, and therefore a supplementary circular has required to be issued. And I think this covers various situations. The first situation is a situation where a manufacturer who sells a machine is also required to give a warranty, a 1-year warranty, which is embedded within the along with the sale of the product. Now, if during the warranty period, if there's a replacement of parts, then whether there is a GST on the said replacement of the parts, and if no GST is payable, whether any input tax credit is required by treating the said supply of parts as supply of goods which are free of cost, and thereby invoking section 17(5) of the CGST Act. Those were the concerns, and to answer these concerns, Circular 195 rightly explained this entire matrix to say that, look, if parts of goods are supplied under a warranty contract, that warranty contract is a part of a bundled supply of product along with a warranty, and therefore there is no independent supply requiring you to pay a tax a second time on the goods so supplied. Again, it's not a supply free of cost, and therefore no ITC is also required. And all of this was clarified in 2023 by Circular number 195. Now, having given this type of a clarification, the industry was happy with it, and naturally they expected issues to get resolved. But some places, the department, especially in the context of electronics sector, when you look at mobiles or small electronic products like pen drives, etc., one would find that there's really no parts of goods which are under warranty. The product itself, the entire sale itself is under warranty. So the pen drive which is being sold itself is under warranty. And therefore, if it is not functioning, the entire pen drive will be replaced. And then the department was reading the circular to say that, look, this circular clarifies only if a part of a goods is replaced by under warranty. So if you are selling a motor car and you are replacing, let us say, an engine, which is a part of the goods, I will give you the benefit of the circular. But if you have sold a pen drive and you are replacing a pen drive under warranty, we will not give you that benefit. Now, naturally, this was not the correct interpretation or the correct logic. And that's where, again, we have a circular which is being issued in 24. This 23 is a typo. Circular 216, which says that even if the goods are supplied in totality under a replacement, under a warranty by the manufacturer, again, no tax would be payable. Similarly, when you're looking at a distributor, the same scenario is being repeated. They are saying that instead of the manufacturer, if the distributor is supplying parts or goods from his own stock, and naturally, because the warranty was an obligation of the manufacturer, if the distributor is supplying these parts and goods from his own stock, he will expect a replenishment of this stock. So he will first supply goods from his own stock, and thereafter he will send a statement to the manufacturer and tell him that, look, I have during this month supplied so many parts to satisfy your warranty requirements, and the manufacturer will then replace those much parts and give it back to the distributor. So again, we are told no tax is payable. This cannot be treated as a non-monetary transaction of a barter of goods, even though the same goods have not moved, but the generic nature of the goods, it's the same type of the goods which have moved. So maybe the part number may not be the same, but that does not matter. The third situation naturally is a case where distributor, after supplying parts from his own stock, does not get back the stock itself, but gets a reimbursement in monetary terms. And here, the circular rightly addresses it and says that this is indirectly a consideration. It's a monetary consideration paid by the manufacturer for the supply of the parts to the end consumer, and therefore tax is payable on these types of transactions with corresponding input tax credit to the manufacturer. Finally, as far as extended warranty is concerned, the interpretation which the department at times was taking was that they were artificially bundling the extended warranty, for which there is a separate price consideration, along with the basic supply of the product. Now, we are aware that, when you buy a product for 1 lakh rupees and you are told that we will give you an extended warranty, instead of 1 year, you can take the warranty for 3 years, you pay 10,000 extra. And typically the interpretation the industry was taking was that this 10,000 is an independent service and apply the tax as per the service provisions. The department wanted to club this extended warranty along with the supply of the product itself and apply the product rate. Keep in mind that many of these products may be bearing the higher tax rate of 28%. And that's where the controversy was coming up. So here again, the circular clarifies that if the extended warranty is given at a separate time than the supply of the goods itself, or if the supplier of the extended warranty is different than the supplier of the product itself, in that case, you cannot treat it as a composite supply, and the extended warranty will be treated as an independent supply of services. Again, all in all, a fairly beneficial clarification, and many people would take advantage of that type of a clarification in the overall context of the thing. Now, these are some amendments, friends, which were relevant to the basic core concept of what is the interpretation of the word supply. We are also aware that we have section 7(1)(c) read with schedule 1, which deems certain transactions to be supplies even if they are made without consideration. And here, because there is no monetary flow, there is no consideration involved, this becomes even more tricky. As far as supply of goods without consideration is concerned, you still have a movement of goods and it is still trackable. There are e-way bills, there are delivery challans and things like that. But when you say service, and service is defined to mean anything other than goods, and you now no longer have that guiding light of consideration or flow of money, how are we going to interpret this? And this is where we have seen right from the day the GST was introduced, a lot of litigation around this point. How are we going to define a supply of service between distinct or related persons, even if made without a consideration? If there are two persons and if two distinct persons, I would say, not actual persons, let us say the head office and a branch. If a branch derives some benefits because of the activity carried on by head office, does it mean that there is a supply? Are we going to define a supply between a head office and a branch based on mismatch in cost and revenue? What are the principles or the guiding forces on the basis of which you will be defining a deemed supply? I would believe that answers are very evasive, and we have seen lots of investigations happening around this point. There have been arguments to say logo given by a parent company to a group company, used by a group company, is a service. It's let's say if a parent company's name is a part of the name of the subsidiary company, again, whether that is a service. As I was highlighting in the preamble, there was a controversy of whether investing in a subsidiary itself is a service given by the holding company to the subsidiary company. All these controversies are coming because service is defined in a very loose manner, and we have schedule 1 which says supply of services between distinct or related persons without a consideration is a deemed supply. And specifically in the context of corporate guarantees, this has been escalated to a point of a boiling point. And we are aware of the broad controversy and the fact matrix. Typically, a parent company might stand as a guarantor for a loan taken by a subsidiary company who would be borrowing some monies from the bank. So there would be a lending contract between a bank and a borrower, whereby the bank would provide a loan lending service, and against that it would get a consideration by way of interest and processing charges. So that's one transaction which would typically happen. Naturally, the bank would want a safety for the money, and subsidiary company being limited liability company, they would want a comfort that if the subsidiary company defaults, the parent company will make good the default or the losses. And therefore, most of these contracts would require, lending contracts would require a guarantee by the parent company or the directors. In fact, the RBI guidelines also require that there should be a guarantee given by the parent company and the directors or the shareholders. So therefore, the guarantee is given, and guarantee, again, as we are aware under the Contract Act, is a contract between a guarantor and a bank, whereby the contract guarantor agrees to stand as a guarantor and provide the guarantee that in case of a default, the amount will be paid by the parent company. The question is whether this contract for guarantee has a consideration. And to address that, the Contract Act specifically says the fact that the bank is giving a loan to the subsidiary itself constitutes sufficient consideration for the guarantee contract. So make no mistake, here you have two enforceable contracts. One is between the bank and the borrower, which is a lending contract. One is a contract between the bank and the guarantor, which is a guarantee contract, wherein the consideration for that guarantee contract is the agreeing of the bank to give a loan to the subsidiary. Naturally, there is no consideration to this type of a transaction, but because the parent company and the bank are generally not related persons, it does not present a challenge. The challenge comes is the department says that, look, because the parent company has given a guarantee to the bank, the borrower gets the benefit of the loan. Therefore, despite there being no specific contract between the guarantor and the borrower, the parent company and the subsidiary company, the department presumes a type of a service and says that there is a service given by the parent company to the subsidiary company. And there was a lot of debate which was happening on this front. A lot of investigations were going around. And I think the key questions which were coming up was whether there is a supply of service. Because before we go into any other aspect, you have to examine whether the taxable event has triggered or not. And this question honestly is still not addressed. Essentially, if you ask me what is the service given by the parent company to the subsidiary, maybe we may not have a very clear answer. Unless we want to reconcile to the fact that mere benefit is a subsidiary, is a service. That is a little bit of a tricky type of a position to take. Now, putting that aside, the question which was also being addressed was how to value the said supply of service. And as an alternative argument in all these litigations and representations, the submission was that the proviso to Rule 28 should be applied and the invoice value should be accepted. And if nothing is done, then invoice value of nil should be accepted. And therefore, so long as input tax credit is available to the subsidiary company, the borrower, there should not be any challenge in this type of a situation. And somewhere the GST Council was apprised of this situation. And therefore, in October 23, we are aware that there was an amendment whereby corporate guarantee, valuation of corporate guarantee was excluded from Rule 28.1 and a specific rule, sub-rule 2 was introduced, which said that 1% of the value of the guarantee will be deemed to be the value of the services given by the parent company to the subsidiary company by way of guaranteeing the loan. Of course, this 1% of the value did not have the safeguard of a proviso like what we had in Rule 28, saying that if full input tax credit is available, whatever value you pick up will be acceptable. Now, this amendment opened up another floodgate of litigation and matters were again taken up to the courts, and Delhi High Court has already granted a stay on the entire provisions in this effect. Now, when we are looking at this entire context in which the controversy was being created, we have now a series of amendments and clarifications. We start with an amendment to the Rule 28.2. The Rule 28.2, which was introduced in a bit of a hurry in 2023, we are now amending that rule to say that it will apply if the recipient is located in India. Therefore, effectively, we are trying to say that Rule 28.2 will not apply to export transactions. Again, the rule said 1%, but it was not specifying a period. So then there was a controversy that if there is a guarantee given for 5 years, whether I have to pay 1% for a 5-year guarantee and 1% for a 1-year guarantee, then perhaps the interpretation and right interpretation was that 1% was vis-a-vis each instance of giving a guarantee. To arrest that controversy to bud, we are told that we are now saying that in the rule, we have introduced the word per annum. So therefore, 1% now becomes a periodic type of an implication. So, and if the guarantee is for, let's say, for a 6 month, then a proportionate working will have to be done for that 6 months. So we now have a clarity on this front to say it is going to be 1% per annum. Interestingly, the proviso which was missing in the earlier regime from October 23 onwards is now brought in. So we are told where full input tax credit is available, invoice value will be acceptable. And if the invoice is not raised, then naturally we have another clarification which says 0 will be treated as the invoice value. Make no mistake, the whole objective of Rule 28.2 was to carve it out from the general rule of 28. Now, with this type of relaxations, we are essentially questioning whether you really needed Rule 28.1 separately and Rule 28.2 separately. Be as it may, this is what we are given. We are also given some further clarifications to say that Rule 28.2 is not applicable to guarantees issued prior to 26/10/2023. Which was again logical because it could not have the valuation provision could not have a retroactive applicability. But please make a note that Rule 28 is only a valuation provision. We have still not addressed the fundamental question of whether there is a supply or not a supply. I would assume that by introducing a valuation rule, the government is indirectly saying, though not directly and explicitly saying, but indirectly saying that there is a supply. This could be questioned on a legal basis, but from the government's perspective, I think the thought process is clear that there is a supply. And if there is a supply, make no mistake, for earlier period also, Rule 28 would be applicable, but Rule 28(1), which would have given you the benefit of the proviso to in case of full input tax credits. But it does not mean that for the past period the matter is rested. It does not mean that. Again, we are told that if there is a bank and there is an assignment of a loan, then further assignment of the guarantee will not tantamount to a fresh guarantee, and again you will not have a second level tax coming up on that front. An interesting proposition is sought to be given in case of co-guarantors. We are told that if there are two co-guarantors, both of them guaranteeing the same amount, then the valuation will have to be done on a proportionate basis. Again, this is a clarification through a circular, not coming out anywhere from the interpretation of the legal provisions. But again, because it is a beneficial provision, one would always take it with full heart and accept that proposition. As far as import transactions are concerned, we are told that the tax is payable on a self-invoice basis, and we have a very detailed discussion on this a few minutes later. So we'll park this point at that point of time and see whether self-invoice value of 0, how does it have an impact on this entire transaction. So when you look at the corporate guarantee space, I can keep on talking about it because there are lots of issues around this. But since this is a larger type of a discussion, we'll limit it to a few slides and just understand what are we trying to talk about in different scenarios. A first scenario would be that the guarantor and the borrower both are in India. Then we are told the Rule 28(2) will be applicable. If full ITC is available, then whatever you have a flexibility, whatever is the value as per invoice, you can be raising up invoice in that manner. You can define that value and pay GST on that. And naturally, the recipient will claim the input tax credit. If full input tax credit is not available, then this rule of 1% per annum or consideration, whichever is higher, will trigger, and you will be required to apply that rule in this situation. If the guarantor is in India and the borrower is outside India, make no mistake, Rule 28(2) does not applicable. But the definition of supply, if we assume that there is a supply, is applicable. And therefore, one will go back to Rule 28(1). And under Rule 28(1), there is a concept that the value will be defined to be the open market value. Of course, there's a proviso, but because the recipient is outside India, he is not eligible for any input tax credit. So therefore, the proviso to Rule 28(1) will not be helpful in this situation. The open market value will have to be calculated as the value for the supply if you assume that, if you agree that there is a supply of guarantee service. And then the question which comes up is whether, since the recipient is located outside India and the place of supply is outside India, whether the zero rating benefit is available. That could be another debate in itself. But I would believe that Section 2 of the IGST Act, which defines the conditions for export of service, does not use the word value. It uses the word consideration. And therefore, if the consideration is 0, I would believe that the condition of receipt of consideration in convertible foreign exchange gets satisfied automatically. And though you have a notional valuation rule under Rule 28(1), I would believe that that rule gets satisfied in this situation. And therefore, the zero rating should be available, resulting in honestly no tax implication. If the guarantor is outside India and the recipient is in India, we are told Rule 28(2) will apply. And if ITC is available, then the value as per self-invoice, it could be 0 also, will be acceptable and no issues on that front. If a full ITC is not available, you will have to then go to Rule 28(2) and say 1% or consideration, whichever is higher. If both parties are outside India, naturally, the entire provisions itself do not apply to that type of a situation. So that takes care of corporate guarantees. We now go to the import of service, and an interesting clarification in this regard. We are told that in case of distinct persons or related persons, if there's an import of service, if the recipient is eligible for full input tax credit, then as per the proviso, the value will be acceptable. Even if there's a zero value, even that zero value will be acceptable. Now, the issue which is now brewing up is a situation where there is a transaction between an overseas parent and an Indian subsidiary. And while they are related persons, there is a defined consideration. And we are aware that for international transfer pricing and even for commercial reasons, there are arrangements of royalty being paid, remitted by an Indian company to a foreign parent. And those foreign exchange remittances actually happening. And over a period of time, we have always been discharging GST on that under RCM and claiming input tax credit wherever available. Now, assuming full input tax credit is available, can this circular change the way it is drafted, change the entire interpretation? And the issue comes up especially in the context where there is a substantial accumulation of credit on account of inverted duty structures. And there, the Indian companies are always a bit resistant that, look, this cash outflow which I do on account of RCM, though I am eligible for full input tax credit, it is only creating a paper asset. It is not eligible to me as a refund, and therefore it's not just a cash flow. It stays in my balance sheet, but I never have a visibility of when I will be able to really get that money back from the government. And that's where one starts prodding into the provisions into a little bit more detail. And this circular somewhere gives us a little bit of an ammunition to prod a bit in detail. If you look at section 15, 15 is the act, is the provision under the act, the substantive provision which will define the value of taxable supply. And we are aware that section 15(1) says that the price actually charged will be the value of taxable supply if the parties are not related and price is the sole consideration. Naturally, since the parties are related, section 15(1) is not applicable. You straight away go to section 15(4), which says that in cases where section 15(1) does not apply, the government will prescribe the manner of calculating the value. And that's where you have rule 28(1), which has various situations. It says that the first preferred value will be the open market value. The second value will be the value of like supply if open market value is not available. And thereafter, we are going to rules 30, 31, which basically takes you to cost plus, etc., etc. We may go back and read that rule 28 and we will find that the entire rule 28 does not have any reference to price or consideration. And therefore, once you come to rule 28, which you need to come for all related party transactions, even if there's a monetary consideration, the concept of consideration is given a go by. And what you have to find is the open market value or the value prescribed in the rule 28(1). And then there's a proviso to this rule, which says that if recipient is eligible for input tax credit, then the invoice value will be acceptable. Again, make no mistake, the invoice here is now clarified to be the invoice issued by the recipient. Therefore, if as a recipient, I am issuing an invoice under section 31(3)(f), mentioning the value to be 0 or a value to be different from the consideration, the issue which will come up is, will I pay a tax on consideration or will I pay a tax on the value which is reflected in the self-invoice? And again, coming to the rule 46, which defines what the content of the invoice, even rule 46 refers to the value and not consideration. Therefore, one may say that as far as related persons is concerned, the value becomes the important matrix and not the consideration. And even if the value is lower than the consideration, value will have predominance and one may be able to optimize the tax flows to some extent. I am aware this could be slightly litigative because when audits happen, the department is always going to pick up your foreign exchange payment schedule and demand a tax on that. And you will have to litigate this matter on the basis of these arguments, which we just talked about. A couple of more clarifications relating to loans. Again, saying if there's an interest, it's anyways exempted. If there's a remittance of a processing charge, if there's a remittance, it will be taxable as an import of service. But if nothing is charged, you cannot impute a notional valuation for that. Similarly, as far as ESOPs is concerned, we are told reimbursement of cost of the shares is not liable because it's a payment towards a security. But if there are some processing charges levied, then those processing charges would be liable for GST. And that takes me to a very important concept, and we might spend around 8-10 minutes looking at this concept because this has been plaguing us ever since GST has been introduced. We are aware that we have two distinct concepts under the GST law, one known as input service distributor and one known as cross charge. Cross charge again is not there in the law, but there's a popular connotation known as cross charge, which typically deals with Schedule 1 services supplied by a distinct person or a head office to a branch or a branch to a head office. We also have this input service distributor, which has its legacy from service tax regime, which facilitates a distribution of input tax credit by an office, which is receiving invoices towards services for or on behalf of other distinct persons. When GST was introduced through a series of FAQs and sector-specific clarifications also, we understood that ISD is optional. It's not mandatory. If you want the benefit of distributing, having a central procurement of an invoice and distributing that invoice to the branches, you may obtain an ISD. As far as supply between distinct persons is concerned, there was always an ambiguity of what exactly is the scope of the supply between distinct persons, whether salaries should be cross-charged, what should be the basis of cross-charge. There was always a bit of an ambiguity. But then there was a circular which clarified most of those issues, saying that employee cost need not be cross-charged. It was also said that because of the proviso to Rule 28, where full input tax credit is available, whatever value is portrayed on the invoice will be acceptable. And that circular is not being disturbed. So we have that comfort as far as cross charge is concerned. But in overall context, what was happening was there were certain challenges. There were conflicting interpretations by field formations and advanced ruling authorities. And the larger challenge which was coming was that the states were unhappy with the current flexible mechanism of ISD being optional, especially in the context of block credits. So, for example, what was happening was most of the companies would have their corporate office in a metro city like Mumbai, and they would take a group mediclaim for all the employees all across the country. Naturally, the insurance company will raise an invoice favoring the head office. And because the insurance company also may be in Maharashtra, they would plot CGST and SGST. The taxes would be plotted in that manner. As far as the company is concerned, they will treat it under Section 75 as a block credit, and therefore the entire state component would stick in the state of Maharashtra. Whereas the actual employees are employed in the 10 or 15 states where those employees are scattered. And therefore, those states were feeling that though the service is consumed, the insurance service, the benefit and the use of the insurance service is in my states like Rajasthan, Karnataka, etc., we are still not getting any money or revenue. And that's where the states were not very comfortable with the current approach. And at the insistence of the states, we now have a situation wherein we are told ISD will be mandatory. We had that amendment coming in the main budget in the month of January. That amendment is still not notified. And we, in the series of amendment to the rules, the rules for ISD distribution have also been proposed to be amended. So again, not notified. So we will find a date which will be notified for making both of these mandatory, the ISD provisions becoming mandatory. And because it's going to have a far-reaching impact, we need to understand where exactly is that line of difference between ISD and cross-charge. And this has been a long litigation. Somewhere in 2019, this issue was discussed by the GST Council. As a part of the agenda notes, a draft circular was issued, but the GST Council, in its wisdom, decided not to give a sanctity to the draft circular, and it did not see the light of the day. The matter kept on getting postponed for a few years. And now perhaps that matter will become relevant because now we are going to say ISD becomes mandatory. There is no authoritative guidance on what exactly is ISD or cross-charge other than this draft circular. So for our discussion today, we will just anchor point on the draft circular and assume that this is the thought process which is going to continue whenever the ISD is made mandatory. And if you go to the draft circular, this is a diagram from the draft circular and certain illustrations which are given in the draft circular. So the draft circular talks about a company having a head office and 2 branches. And then it says that there are various types of services. There are certain services procured by the head office. And the example they are giving is there is a security service where there are some securities at the head office, certain security staff at branch office 1, certain at branch office 2. But there's a central invoice which is centrally raised to the head office. And then the clarification given in the circular is to say that this is a situation where there is a central procurement, the invoice is received by the head office, but the service is itself received by the branches. Therefore, this should be treated as an input service distributor. The head office should obtain the service, obtain the invoice in the ISD registration and distribute it by way of an ISD registration. Thereafter, they have given a clarification relating to an admin team or a tech maintenance team. They are saying that there are some employees at the head office. Those employees help all the branch offices in maintaining their laptops, in the administrative support, etc., etc. And here, the circular says, the draft circular says that these are essentially in the nature of internally generated services. And therefore, these become a subject matter of cross charge. Make no mistake, after this draft circular, we have an actual circular in the context of cross charge saying that employee cost need not be cross charged. But this draft circular says that their employees are internally creating a service and supplying that service to the branch offices. This becomes important as we move further into some practical examples from an ISD perspective. And finally, they have said that if one branch supports another branch by helping them develop software, because it was a software development example, then again, that's a service given by branch office 1 to branch office 2. So what we say is project branch transfer, that gets covered there. So if we assume that this draft circular represents the thought processes of the department, in that case, one would perhaps feel, and again, this is a little bit tentative and may change based on the actual clarification as and when it does come in and nearer to the date of the notification. I would believe that any service would typically have three different facets. One is the contracting, meaning the place from where the purchase order is issued and the place where the invoice is received and processed. The second is a place where the service is actually received, provided and received. And finally, there could be a third facet of a service wherein the service is received at one location, but the benefit of that service is derived by another location. And depending on what is not congruent, you might have either an ISD or a cross charge. So a situation where a contracting is not congruent with a receipt, you will have a situation of ISD. The typical example being a security, where you will find that though the PO is raised from head office, invoice is received by in favor of the head office, the actual security is provided to the branch and consumed. The security service is consumed by the physical fixed establishment at the branch. If these are the situations or the fact matrix, it will become ISD. But if a service is contracted and received by the head office, but some part of the benefit of that service is flowing to the branch, it would be a cross charge. An example of an audit fee contracted and received at the head office level. The benefit of that audit might pass on to the branches, but the receipt of the audit service happens at the head office. And I would believe those types of situations can continue to be under the cross-charge mechanism and not under the ISD mechanism. Of course, there could be a very thin line of difference, and for a similar type of a transaction, depending on the purpose for which the expenditure is incurred and where it is being used for, the answers might change slightly. So coming back to a few live examples which we may talk about. The first two examples are given in the draft circular and we already talked about it, so we'll not go into detail. But yes, when you look at ISD, I would believe that things like central procurement, and the draft circular has a very specific question dealing with a situation whether the head office can act as a central procurement office for processing all invoices country-wise. And I would believe that's the limited objective of ISD. That yes, it is a facility which permits an entity not to process POs and invoices at 10 or 20 different locations, but have a central processing unit which will be registered as ISD. So typically, let's say you have 5 factories, you pay all the GTA under RCM at the ISD level in Maharashtra at your head office, and then distribute that GTA. I would believe that's perfectly permissible. And that's the type of a situation which will have to go under ISD if you are having a centralized procurement. I understand as far as GTA is concerned, most of the factories would be decentrally paying the RCM and claiming the credit. But if you want to do it in the head office, perhaps this would permit you to do that. Same way, you might have a custom house agent who is centrally located in a, let's say, the head office, and he would be providing invoices in the head office name for all clearances from the relevant factories. So again, that could be an ISD mechanism. Insurance of assets at the country level would be a part of an ISD. We talked about Mediclaim, and please note, as we move further, we look at the statutory provisions, we'll understand that ISD is required to be done even for ineligible credits. So Mediclaim insurance, fixed, wherever you might have an asset insurance, stock insurance for stocks lying at various locations. All of these, the services are consumed and received at a local location. It's not just the benefit flowing into that, but the actual service is flowing into that. Software licenses for all the laptops where you have various softwares which are installed. Then actually the service software itself is installed on that laptop at a local location. Therefore, that again is a situation where the service is received at the branch, but the invoice and the PO is centrally procured. Travel cost, repairs, hiring services. These are all examples which ideally would go under the input service distributor. As compared to that, examples like audit, legal expenditure. You might have various types of expenditures where the expenditure is received. I mean, the service relating to that expenditure is received by the head office. Maybe it is then consumed by the head office to further generate a service and provide that service to the respective branches. In those situations, I would believe that the cross charge should be fine. Coming to the provisions of the law, understanding this distinction between an ISD and a cross charge, we are given this definition, which now somewhere makes it mandatory. Section 20, subsection 1 obliges that office to register as an ISD and to distribute the credit. We are then told that the credit has to be distributed in the manner prescribed and the conditions which are mentioned therein. And if there is any excess distribution, and this is where the difficulty arises. We are told that if an ISD distributes in a manner which is different from the prescribed provisions, the excess distribution shall not be recovered from the ISD, but shall be recovered from the recipients along with interest. So if there is a distribution from the ISD to 5 branches, the litigation will arise at each of the 5 branch level, and the show causes will be issued at each of the 5 branches and not at the ISD level. And that really results in a lot of complications in terms of compliance and documentation requirements. Rule 39, which has been proposed to be amended, we now have a detailed procedure of how the ISD provisions will be implemented. We are told that the ITC available for a month is to be distributed in the same month, and that would happen through the GSTR 6. There's a form through which it will happen. There are 3 layers in which the distribution will happen. If the input tax credit is attributable to a particular recipient, it will go only to that recipient. If there is a cluster of recipients, then it will be sent to the cluster of the recipients on a pro rata basis, which is basically the turnover of the previous year or the previous quarter. And if it is attributable to all the recipients, then it will be on that basis to all the recipients. So accordingly, you have to use the rule of 3 and apply it. We are all accountants, so I'll not go into the nitty-gritties of this. And again, we are told that you will separately distribute both eligible as well as ineligible credits, and the blocking of credit will happen at each of the branch or the recipient level. Again, integrated tax will be distributed as integrated tax. Central and state taxes will be distributed either as central and state tax if the branch is within the same state, or as integrated tax if it is within another state. The distribution will happen through a document known as ISD invoice. If there are errors or omissions, you can issue a ISD debit note, credit note. Similarly, for an original invoice issued by a supplier, if there is a credit note issued by a supplier, then the ISD is obliged to issue an ISD credit note for distributing that supplier credit note. Now that ISD credit note will also have to be distributed on the basis of original distribution ratio and not on the basis of the distribution ratio of the credit note month. So you will have to link it to the invoice and go back to that month, look at that ratio and apply that ratio whenever the credit note is being passed on to the different units. This we are aware, so I'll take it very quickly. The broad distinctions between ISD and cross charge. We are summarizing the concept to say that when you're looking at ISD, it's only a distribution of input tax credit. There is no output tax. As compared to that in a cross charge, the input tax credit is availed by the normal GSTN and then it is claimed as a credit and output tax is charged to other GSTN. And therefore, there is a difference in the invoicing. ISD issues an ISD distribution invoice, whereas a cross-charge transaction, there would be a normal tax invoice. ISD distribution invoice will not require an IRN, whereas the cross-charge document will require an IRN if applicable. And today, most of the places, an IRN is required if the turnover is above 5 crores. Valuation, as far as ISD is concerned, there's no concept of valuation because it's just a distribution of input tax credit. As far as cross charge is concerned, we are aware of the proviso to Rule 28, which says that the cross charge is optional in case of full input tax credit. There's an impact on accounting as well, because in a cross charge, you will plot sales, purchase, output tax, input tax credit, all those ledgers would get impacted. And of course, at the time of consolidation and finalization, you will nullify the sale and purchase transactions. But in ISD, you will only distribute the input tax credit GL of ISD to the branch ISDs, branch ITC GLs through a journal voucher. As we saw in the provisions of Section 20, all the obligations are cast at the end of the recipient. And that is where I think the bigger challenge rises. The requirement of 180 days reversal for non-payment to the vendor will have to be done by the recipient on a proportionate basis in the case of ISD. Now, this is where I think administratively there is a big challenge, because the entire payment and all is tracked by the ISD or the head office. They will have to then keep a track of it and then give that intimation or a statement to the respective branches to reverse the input tax credit in their returns. Same thing, supplier unpaid tax rule 37A. Again, it will be happening at the ISD level. The challenge again, which we see, is that rule GSTR 6 does not have a specific column for the 3B filing status. And therefore, this will have to be a more like a manual exercise to be undertaken by the ISD to check whether each of the suppliers has actually filed the returns or not. We talked about credit notes, which has to be distributed through ISD in the same manner. As far as Rule 42 is concerned, again, the reversal will happen at the recipient end. I do not see a major challenge on that front. The larger challenge which arises is in the case of temporary reversals for ISD. We are aware that because of a circular, if the credit is reflected in the GSTR 2A, you are required to mandatorily claim the credit in that month and make a temporary reversal. Same way, Rule 39 says that whatever credit is reflected in GSTR 6A has to be claimed and distributed within the same month. What if that transaction is not accounted in the books at all? Naturally, there will be a requirement for a temporary reversal. Again, this temporary reversal can't happen at the ISD level. It will happen at the branch level. But the way the GSTR 3B is right now operational, my teams tell me that it is not practical or it's not possible to really track this type of a temporary reversal, and there's no mechanism to handle it. Maybe as the law amends itself, we will see that there will be some changes in this entire provision. This is the broad flow chart, but for want of time, we'll not go into it. Typically, you have some action on each day. You have the GSTR 6A populating to 6, which goes into 2B of the branch. And ultimately, there will be a matching, and the branch will then disclose it in the 3B accordingly. So I think this entire ISD versus cross charge will require identification of various types of situations where this happens. At times, organizations may need to reconsider whether there can be a decentralization of procurement. If organizations have not obtained ISD registration, they may need to do it and comply with these provisions as and when the date is notified. That takes us to the changes in the tax rates. I think those who are impacted by this would definitely have gone through it. I think an important point which we wanted to highlight was the exemption given for compensation cess on imports in an SEZ area by SEZ units or developers for authorized operations. Otherwise, there are all very specific types of exemptions or changes in the tax rate. One interesting exemption brought in case of services is relating to hostels. We are aware about the entry which says that if the charges are less than 20,000 per person per month, and if it involves a minimum 3 months stay, then the accommodation services will be exempted. And for the past controversy, we are told that a similar benefit will be given and the past will be regularized on a as is where is basis. Coming to the valuation of supply, and this is one circular which is a bit tricky and I would say not really a beneficial circular, and that deals with the issuance of certificates by professionals, chartered accountants, or by the organization for credit notes. And the background to this, as we are all aware, is the situation that a credit note might be a GST credit note, and if it's a GST credit note, the supplier would claim a reduction in output tax. And Section 15 says that such reduction is permitted only if the recipient has reversed his input tax credit. And as of today on the portal, there is no mechanism to effectuate that type of ensure that the recipient has reversed the credit. And therefore, this circular says that, okay, the officer can take a certificate from the CA or cost accountant, and that certificate may include certain details. And if that certificate is given, then this provision will be complied with, and the adjustment of output tax will be given to the supplier. We are also told that self-certification is okay if the value is below 5 lakh rupees per financial year per person. The circular talks about past periods also and says that the certificates for past periods may also be acceptable. And the key challenge which we see is that the circular relates to discount, and rightly so, because the section 15 deals with discounts, post supply discounts. But we are aware that section 34 dealing with credit notes is much wider. And we are seeing many situations where credit notes are issued for error in generation of invoice or rejection of goods. The circular may not apply to these types of credit notes, but at a department level, the department may, the officers may look at it in a very myopic manner, and they may treat all credit notes similarly and insist on certificates for each of those credit notes. And practically, at a taxpayer end, in many situations, getting those types of credit notes can be a little bit of a challenge. This is again a beneficial type of a provision wherein if there are exports of goods on payment of tax, we are aware that the rebate is automated through the customs route. At times, if there's a subsequent price adjustment, then the output tax will have to be discharged. And while refund is eligible, there was no procedure to claim that refund, and therefore we are now having a circular along with the amendment in the rules, which says that the differential tax which has been paid due to a subsequent price adjustment, you will find a refund application in RFD1, and the GST officer will verify and sanction those refunds. So I think that's as far as this point is concerned. This is a big relief which we are trying to bring in. Of course, it's a bit timed, but we had a lot of challenge over here. Section 16.4 arbitrarily defining a timeline for claiming an input tax credit up to the September and thereafter extended to 30th November. People filing returns late or missing out claiming credits by that time, and department denying those credits, matters going to the high courts, most of the high courts giving verdicts which are against, except one later high court M Trade Links, which tried to interpret the amendment to be retrospective amendment and saying that 30th November should be taken for the previous years as well. As a magnanimous point, we are now introducing section 16.5, which says that for a time limit for financial years up to 2021 will be deemed to be 30th November 2021. So if you have claimed the credit in any of the returns filed up to that period, then the entire credit will be eligible to you because of the proposed insertion of section 16.5. Similarly, if there was a cancellation of registration and because of which you were unable to file returns, then if you are filing the returns within 30 days from the revocation of cancellation, you will be eligible to claim the credit even if the timelines have lapsed. While this concession has been given, we need to bear in mind that there would be many people who would have already paid up this amount because of litigation. And that's where there is a clause in the finance bill which says that no refund will be granted of a tax which has already been paid or ITC already reversed. So I think a good beneficial provision, but limited applicability because of the as is where is concept, no refund of tax already paid or ITC already granted. Just one point I would like to address here is that the clause talks about no refund of tax or ITC. It does not talk about interest and penalty. And if an entity has paid interest and penalty and the matter has not adjudicated, voluntarily he has paid either interest or interest and penalty, the question is whether the refund of interest and penalties can be claimed. I would believe there is no specific debarment from claiming a refund of interest or penalty, because once section 16.5 comes into place, you have a situation that legally the tax credit was eligible, and therefore if credit was eligible, the question of payment of interest does not arise in that type of a situation. We now have another clarification, and again this clarification, if you look at it, there's a lot of flexible interpretation, I would say, which is sought to be canvassed of the provisions of the law. We are aware that as far as RCM is concerned, the registered supplier is expected to issue a tax invoice, upload in 2A, and you are required to pay the RCM based on that transaction. And the upload in 2A itself constitutes your duty paying document, and you claim input tax credit based on that document. In case of unregistered supplier, section 31(3)(f) forces you to issue a self-tax invoice, and the credit has to be claimed based on that self-tax invoice. Now we have circular 211, which talks about situations where you had forgotten to pay the tax. Let us say 17-18, there was an RCM liability, but it was not paid. And in the course of audit, this was examined. Let us say that happens in 2021 or even today in 23-24 or 24-25. Here, the circular says that in the case of unregistered suppliers, RCM the claim of input tax credit will be determined based on the self invoice. And therefore, if the self invoice is generated today, then my timeline for claim of credit starts from today and I will be eligible to claim the credit. It cautions that the recipient may be independently liable for a penalty. Again, that penalty can extend up to 25,000, but there's a question whether that penalty will apply, because when we go to some another circular and the amendment proposed in the law, you will find that somewhere today there is no timeline for issuance of their self invoice. But despite that, we are told here that there might be some penalty which might come in. Of course, a beneficial circular, we may like to examine all open cases and try to resolve those cases. When you combine this with the amnesty scheme, you will find that there's a substantial benefit which someone might be trying to get from this type of a situation. There are certain clarifications on block credit. I think I will skip them because of want of time. But let me straight away jump to the associated amendment proposed in section 13.3 relating to time of supply. And as we are aware that the time of supply provisions defines the time when the tax liability is triggered. And as far as RCM is concerned, for time of supply of services, we are told that it's the date of payment as entered in the books or debit in the bank account. Or earlier we had these provisions which said that 60 days from the date of issuance of invoice. And that was it. Now we are introducing subclause C, which says date of issue of invoice by the recipient in case where the invoice is to be issued by the recipient. Now, section 31(3)(f) is also amended to empower the government to prescribe a timeline for issuance of self-invoice by the recipient for the first time. And therefore, one may argue that in case there is no payment made, then there was no timeline prescribed for the issuance of the self-invoice in the past. Moving forward, we will have to wait for the amendment for the notifications and then the amendment in the rules to define the timelines which would be applicable to these types of situations. Some further clarifications, very specific, so we will not go into it. I'll straight away jump to the amnesty scheme because that's an interesting and a widespread situation. We have a proposal to introduce section 128A, which will be applicable for financial years 17-18, 18-19, and 19-20. I'm not sure why they want to restrict it only to those 3 years, especially considering that most of the notices for that period would have already been concluded because the normal time period is already over to a major extent. Full waiver of interest and penalties will be given if the demands are raised to 73. Make no mistake, section 74 notices are not covered. It's only section 73 notice. Subject to the condition that you pay the tax fully, interest and penalties will be waived. Again, as is where is basis. So if you already paid the tax, interest and penalty, then you will not get the refund of interest and penalty. We are also told that if the notice is adjudicated and you have filed an appeal, the appeal will need to be withdrawn. And I would believe that they will have to prescribe a procedure, and because essentially there will be an electronic liability which would have been created on your electronic liability ledger. And therefore, we should wait for a detailed guideline on how that liability will get extinguished. And after that, we should action this out. But yes, a beneficial provision where you just pay the tax component and the entire interest and penalties are waived. This is the last part where again most of it is procedural, so I'll quickly take it and then maybe we might have a few minutes for questions. One important point is this GSTR 1A. We are aware of this reduction in the B2C small cutoff limit from 2.5 lakhs to 1 lakh, so I'll not spend time on that. GSTR 1A has been introduced, again a very limited applicability, and supplier has filed GSTR 1, but he finds that there is an error in GSTR 1 impacting his liability in 3B. So before he files 3B, but after he files 1, he can file a amendment document known as GSTR 1A. Accordingly, his 3B liability will get changed in the same month. There was a confusion to start with that what happens to the recipient. Now, the GST portal has issued an advisory and right advisory to say that the impact of GSTR 1A will come in the next month's 2B and not in the current month's 2B. So as far as the recipient is concerned, life is simple. As far as the supplier is concerned, he is now out of the hassles of the liability mismatch and the queries which were coming on that account. So I think in that sense, it is a little bit a beneficial type of a thing. GSTR 7 amendment which says that invoice level details will have to be uploaded. And also there's an amendment in the provisions to say that nil returns of TDS will also have to be filed. The existing concessions for annual returns will continue. So I think that's again an interesting continuity which is coming in. Important change is the manner of adjudication. We are aware that today you have two different provisions dealing with adjudication: 73 dealing with situations not involving fraud, 74 dealing with situations involving fraud. We are told that both these provisions will apply only up to financial year 23-24. From 24-25, we would have a common provision called Section 74A, wherein there will be a common timeline. And there is a very different way of prescribing the timeline. As we are aware today, the timeline is prescribed for the issuance of an order. And you are then told that the notice should have at least a clear 3 months or a 6-month backward period from the due date of issuance of order. So today 73 order has to be passed within 3 years of the annual return due date, relevant date, and notice has to be issued 3 months before those 3 years. Similarly, for 74, 5 years and 6 months before those 5 years. Now we are told we will not anchor point on order. We will anchor point on the notice. So that's in that sense going back to the service tax days where there was a timeline for issuance of a show cause notice. So we are told the timeline for issuance of show cause notice in all cases, fraud, non-fraud, etc., will be 42 months from the annual return due date. And thereafter, order will be passed within 12 months from the date of the show cause notice. And a further extension of 6 months can be approved by the senior officer. Interestingly, if you look combine all these three periods, 42 plus 12 plus 6 months, you end up with 60 months, which is the extended period timeline right now. So we have not really found a middle path. We have actually sort of scrapped the limited timeline available under 73 and increased the timeline in all the cases to the larger timeline. Of course, penalties continue to remain the same. Only concession which we are seeing is the fact that as of today, the concessional penalties are triggered up to a period of 30 days from the show cause or the order, which is now relaxed to 60 days from the show cause or 60 days from the order. There is a change in the pre-deposit requirement when you are appealing, filing an appeal to the GST appellate tribunal. Earlier, there was an additional pre-deposit of 20%, which has now been reduced to an additional pre-deposit of 10%. Even the maximum amounts have been reduced to 20 crores each, both for the first appellate level as well as the GST appellate tribunal level. Of course, 20 crores under each of the tax headings, and therefore under IGST, it will be double of this amount. The GST appellate tribunal is in the stage of getting constituted in the right sense. And therefore, we are told that the time limit for filing appeal would be 3 months from a notified date, because till now the entire infrastructure is not there. Of course, detailed rules have been prescribed now. And there's a circular, and this is an important circular, which says that if the first appellate authority has passed an adverse order and you intend to appeal before the GST appellate tribunal, you have to file a declaration and make a pre-deposit post the confirmation of the first appellate order, so that you will be filing an appeal before the GST appellate tribunal. And then we are also told that there is a manner of adjustment of the pre-deposit through a document called DRC 3A. And GST is all about document numbers, and so you have various types of numbers coming in. An important change is that anti-profiteering will now be dealt with by GST appellate tribunal, the principal bench. And there's a sunset clause that the GST council will notify a date post which there no further anti-profiteering applications will be accepted. So that's good to have that type of a sunset clause. Refunds, we are told no refunds will be given for goods which are subjected to export duty. And there is also a second proviso which denying refund of accumulated ITC in duty drawback clauses claims is proposed to be deleted, because as we are aware, duty drawback is now reduced to only cover the basic component and not the indirect tax component. So therefore, that entire provision becomes slightly redundant in that sense. Small changes, I think an important one from a practitioner's perspective is the fact that under Section 70, we are now told that an authorized representative can appear in response to a summons proceedings. Till now, authorized representatives were not entitled to appear. Now they can appear on behalf of the company or on behalf of the director who is being summoned and record a statement on oath. It's a dual-edged weapon, and we have to be a little bit careful while recording a statement, because there could be other consequences of the misstatement in that recording, which might come up and can create difficulties. So I think with that word of caution, I've already overshot my time. So I would like to thank you all for a very patient hearing, and I would hand it over back to Mandar and Anand to invite questions and take it ahead from here.
Yeah. Thank you, Sunil bhai, for this wonderful exposition as always. Sunil bhai, only one or two questions we will take,
Sure.
in which I think most of the questions which are come up have already been answered by you. But there is one concern about the applicability of this charging provision, section the levy provision, whether it would be considered as a retrospective or a prospective. So any thoughts on that?
I would believe that they would notify it to be retrospective because that's the broad intention. I assume you're talking about Section 9 ENA.
Yeah, ENA.
Yeah.
Yes.
I would believe that they would notify it retrospectively.
Okay. And one more thing about the uh, amnesty scheme regarding whatever has been paid. So how the pre-deposits would be considered in that?
Uh, my answer would be that the pre-deposit also bears the character of the tax. And therefore, it would be a little bit ambitious to expect a refund of that pre-deposit. And honestly, if you look at the pre-deposit today, the pre-deposit is only of the tax component.
But it
Unless
will
you
be
are
adjusted against the taxes.
it will
At
get
least
adjusted and only the balance will be payable, and interest and penalty will get waived.